just to get started here, this is our annual tax planning webinar. We do this every year just to go through kind of key tax planning things that you should be considering and thinking about for the year. I'm Owen Bondurant. I'm a partner in the company and have been a partner in this company since it was founded in 2014. Just a few housekeeping things. We are recording this webinar. It will be sent out by email and social channels if you have to drop off or want to share it with someone. In addition to that, in the Q&A, which thankfully we had up and running because people told us they couldn't hear us, we will be taking questions throughout the webinar, and we'll try to either address those as we're going or at the end. If you don't know Independent RX, we provide services to independent pharmacies. We help people start and buy pharmacies, and we provide accounting to independent pharmacies, and specifically we do financials, we do bookkeeping, we do taxes, and we provide data services to clients to help them operate. And then we also help people sell pharmacies. That's kind of our business. We've been doing it for about 14 or 10 or 9 years now. And so I'm going to pass it over to Rich, let him introduce himself, because Jim and Rich are going to do most of the talking.
Okay. Yep. Thanks. My name is Rich Danhoff, and like Owen said, I'm a partner here. A little bit about my background. I am a CPA. I'm not a pharmacist. Started out with PricewaterhouseCoopers a long time ago. Spent 5 years in one of the big four now public accounting firms, and then spent another 10 years in a Fortune 100 technology company, totally unrelated to pharmacy. Decided that I wanted to own something like many of you, and have a little more skin in the game and a little more control of my future. Started my own consulting company. Met a guy named Tim Clark who had a partner in Mark Bondurant, which was Owen's dad, and had 7 or 8 stores here in Ohio, and got into the pharmacy business, and spent the last 16 years as an equity minority partner in that business with Tim and Mark, and transitioned as we transitioned and sold off many of our stores. We began this piece of the business, which has grown rapidly. I think there's a big demand for what we're doing, and kind of came to accounting not as an accounting firm learning pharmacy, but as a pharmacy and a pharmacy owner, and as accountant within pharmacy, coming to the accounting and tax side to help other pharmacies. It's all we do. We don't do other businesses. We don't do personal returns. We do pharmacy. And so it's kind of a unique niche that we operate in. There's 20-something thousand independent pharmacies out there, and so there's a big market, and we work with independent pharmacy owners, and I've learned a lot. Spent again 16 years owning pharmacies and buying and selling and opening and closing, and learning from our positives and our mistakes along the way. And that's kind of what we bring now to our pharmacy clients. And like Owen said, today we're going to spend most of the day talking about the tax side of the equation, which is a huge part for owning your business, is the tax implications.
Hi, I'm Jim Sunderland. I'm the tax director here at Independent RX. I've been here for about 3 years now. I just like Rich, started out in public accounting. Showing my age by saying at that time there's 8 big firms, but now it's consolidated down to 4. I was also with PwC. And I've spent my career, in finance and accounting since that time. And I've spent about over 20 years being a CFO at 3 different companies prior to joining IRX. So I'm glad to be here today talking about taxes. So.
Yeah, the crazy world of pharmacy, right? A very different business, and
it is.
So it's got its challenges, and it takes a while to really get your learning and understanding of what pharmacy is, what's so unique about pharmacy with DIRs and rebates and all the things that go on, and how we get compensated. So, Jim built our tax department, so a lot of this is going to be, as we talk through, we'll talk through a lot of the tax implications of owning a pharmacy.
Yeah, so let's kind of maybe just talk about tax planning in general. Just how does it work? What's the kind of key points to it? And maybe just give an overview of, I think there's some misconceptions of really what tax planning is. So I don't know if one of you want to start with that.
Yeah, I mean, when we think of tax planning, I mean, I do handle a lot of the sales calls. So people that are looking to join our accounting services or considering joining our accounting services and our consulting services, and one of the biggest questions I get, or the first thing that comes up, is how are you going to save me taxes, right? I'm tired of paying taxes. I don't want to pay taxes. Do you have some magic on the tax side? And the easiest answer is to not make income, right? So if you don't want to pay taxes, don't make income. And that's, I say that jokingly. And I do often say that when I'm talking to clients, but most of what we have in terms of tax planning and tax strategy is what we call timing differences. So it's the ability to time when you pay the taxes, because at some point you typically, if you're going to make money consistently, you're going to pay taxes. And so timing is really important. And I think Jim's going to get into it a bit here. And so there's also some permanent differences where you actually get a deduction and get to reduce your taxes, and we take advantage of those things. But a lot of these things are timing. And we talk about tax planning. It's getting the timing as right as we possibly can, so that when we pay taxes, we're paying the least amount and at the best rates.
Right. Trying to manage things we can control to manage your income down to a lower level and get into those lower tax rates so you can pay less taxes. And that's kind of leads into one of the things we first want to talk about was, there's different tax rates and different tax brackets out there. And we're focusing, this webinar on, flow through entities. So we got, S corps. Most of our small businesses relate to S corps or LLCs or sole proprietorships, but these are all entities that are flow through, where the activities of the pharmacy will flow through to your personal tax return, and then you actually pay the tax versus the company. A C corp there's only one tax bracket there, and that's not a pass-through entity. That corporation pays the tax, and the tax bracket is 21%, so it's straight 21 across the board. But when we get into these, we're talking about really personal taxes, because all this information is going to flow through to your personal tax return. And the rates go from 10% up to 37% right now. They were reduced back in the latest tax act back in 2017, 2018. And the way the taxes work, you've got different brackets. So you start off at 10%. And if we use, per se, a married filing jointly, that's where most people fall into, the majority of people. And the first $22,000 is taxed at 10%. Then the next bracket goes up to about $90,000. So that next $68,000 then gets taxed at 12%. Then it goes up to like $190,000, where the next $100,000 is based on 22%, et cetera. So you get into like up to $350,000 to $450,000, and you get into 24 to 32% rates. So this is where we talk about the different taxes, and it's calculated that way. If you make $100,000, the first 22 is going to be based on 10%. Then the next 68 is going to be based on 12%. So you look at that total calculation, and to get your overall rate, you're going to be looking at what that total tax is divided by your total income. And basically, what we want to do, as we were saying before, is try and manage our income as much as we can, things we can control, to get at the lower rates, because as Rich said, it's all timing, and when we want to pay that tax and stay in the lower rates.
Yeah. So, we want to pay taxes all day long at 10 and 12 and even 22%, but we don't really want to pay. If you're consistently making income in your store, we really don't want to be paying, at 35 and 37 rates. So right. How do we time and manipulate our income in a way that allows us to take advantage of those lower tax rates, pay at lower tax rates, and not pay at the higher tax rates?
Right. And one thing you want to try to do is as you manage your income, sometimes that based on things you've implemented in your pharmacy that, hey, next year is going to be a much better year than this year. Things are just in place and they're really starting to take off and go. So the tax brackets move every year based on inflation. So you don't end up paying a higher tax rate based on inflation, but you do pay higher taxes if you're making more economic income. So if you look at if you know what the brackets are, and then you kind of see next year and kind of plan out. So for instance, you think that next year you're actually going to be making more money for whatever reason, and it's going to throw you in the higher tax bracket. Well, then you might want to look at things that you can do, that you can control to accelerate your income in the current year and decrease your deductions, because that will give you more income this year, and then do the opposite next year. So you want to, have more income and pay when you're in the lower rates, and have less income when you're in the higher rates. So that's what you're talking about, things you can control and what you can manage to go from those brackets. Again, as we said, keep your income in the lower rates. That's one of the big areas we look at when we talk about timing. And I think one of the big things we also talk about would be, depreciation. Depreciation is something you can control. And we say that because there's a lot of options out there on depreciation expense that you can determine which way you want to go. And then that's going to affect the timing of your deductions that you can either use in the current year or in the future. So as we get into depreciation and talk about like different methods you can use, there's maker's depreciation, there's bonus depreciation, there's something called a Section 179 deduction. So we'll talk about that first, starting with makers. If you look at
just basically, what is depreciation, right?
Yeah, good question.
So we're assuming everybody knows what depreciation. I think they do, but example, you buy a car, it's going to be depreciated typically for book purposes. And when you look at accounting purposes, you want to match the depreciation to the use of the vehicle, right? So if you buy a $25,000 car and it has a 5-year life, that means you're taking $5,000 worth of expenses each year for the next 5 years, right? And that's what you would see as book depreciation, right?
Right.
What you're talking about there's a difference sometimes between what you would do for book reasons and what you might do for tax purposes, right? So for book purposes, we're going to use that car and do our deliveries for the next 5 years. We're going to take $5,000 expense each year. But for tax purposes, there are some allowances in the tax code that would allow us to potentially either take it similar to book or to accelerate it, right?
Right. I'm glad you stopped me on that, because we should talk about what depreciation is. And as Rich said, this is really the cost recovery of an asset over its dedicated life. And I say dedicated or useful life, especially for book purposes, you would allocate that way. What happens on tax is that it falls into, based on what kind of asset it is different lives, and that determines how you can take the depreciation on it.
And a big part there, right, is the government trying to incentivize you to make capital purchases and large purchases, right? Because that stimulates the economy. So they're giving you an advantage from a tax standpoint to buy and take a deduction for a large asset purchase,
right,
and accelerate the tax if you so choose. But is it always the best answer to accelerate a deduction, right? We just talked about that.
It's not. Yeah. I mean, and you really have to look at it. And that's where the tax planning comes into play. When do you want to take that deduction, and what options do I have to do that? So as I kind of started into a little early, makers is one of the conventions that you can use for depreciation. And it basically works that depending on the asset, it falls into a different class. And then based on that class is how often what life you take the depreciation over. Like normal machinery and equipment or office furniture usually falls into a 7-year life category. However, if you have IT equipment, computers, things like that, that usually falls into a 5-year category. And the way it works is that, there's useful lives for makers. They have 3-year, 5-year, 7-year, and 10-year. And then there's also 15 and 20-year. The first 4 up to 10 years the standard is a double declining balance. And we'll get into that a little bit more too. The next 2 are 15. And then if you get into that with real estate, whether it be residential or commercial, it's going to be either 27.5 years or 39 years. And that has to be at a straight line basis. So in a normal maker's depreciation, and let's take a 5-year because it's easy to look at figures there. Over 5 years, that's 20% a year you would normally take depreciation. Under makers, it's on a 5-year asset, it's double declining balance. So that means you take double what the normal standard straight line rate would be. So then you would take 40%, and you take 40% depreciation on whatever the net value is of the asset. So if you bought a $10,000 asset in the first year, then you normally have that 40%. However, there's also different conventions, and under standard, you would take a half-year convention. So a 5-year asset, you're actually taking depreciation over 6 years, a half year in the first year, 4 full years, and then a portion at the end that, whatever's left over. So on a 5-year asset, it's a 20% the first year, take the double declining balance, moves it up to 40%. And then under a half-year convention, you only take half of that. So you're back down to the 20% in the first year. So
there's a lot of detail
there.
Yeah.
And maybe too much so.
And yeah. But I guess what we're getting to is that, when you're depreciating an asset, there are some decisions, right? Do we want to spread it? How rapidly, even when we spread it, how rapidly do we want to use makers and double declining balances and so forth?
Right.
And when you're talking about potentially a pro rata max.
Yeah, like we went through this last year.
Right.
Right. We had to buy a new pro rata.
You're not talking about,
it was
$10,000 asset.
Right.
You're talking about a $300,000 or an RX safe for $100,000. Those are fairly common purchases in our industry. Or you're building out a USP 800 compliant room. Yep. Compounding has typically very expensive equipment, hoods and balances and EMPs and those types of things. So how do we depreciate those? So we can either spread them, right, or we can accelerate them almost all the way.
Right. And even if you spread those, you can take advantage of the tax laws in place. I was mentioning about the double declining balance, but you could also choose straight line depreciation, where you can spread that out over that life as the equal amounts each year. So what's the benefit of that? As we get more back into timing, it's about when do you want to take those deductions? Under double declining balance, you're going to take a lot up front, and then at the later years of the asset or the asset life, you're going to take a lot less depreciation. If you would straight line it, you're going to take the same amount each month, or each year, I should say. So that kind of spreads it out evenly. And then you can kind of plan, when do I want these deductions? So I want to talk about, as that's kind of a lead into the next thing. So bonus depreciation. Bonus depreciation is the default now in our tax code. So what happens is when you buy an asset, automatically the default would be that you would take bonus depreciation on that, which means you take a substantial portion of that up front in the first year. Prior to 23, it was 100% bonus depreciation. You would just write the whole asset off in that year. Starting in 23, it's gone down 20%. So now you only can take 80% of that asset, and the rest of the 20% has to be depreciated based on whatever maker's life it has. So a $100,000 asset would be, you take 80,000 the first year, and then the 20,000 you would depreciate over that 5-year life.
So this is a good example, because last year we had to buy a pro rata, and we knew that the following year it was going to be 80-20 rather than 100.
Right.
So we chose to take the entire 100 in that year because we knew we could only use 80 the following and spread it out. So that comes back to the whole timing thing of,
yes.
But in other circumstances,
it may not make sense. It
may make sense to take 15 a year, for the next 7 years, or whatever that math would be, to just reduce our consistent income by $15,000 over the next 7 years.
Especially if you're a very consistent company that makes the same amount every year, and
if you have a huge profit this year, and we saw that sometimes in COVID, right? People were doing a lot of shots. There was a lot of income. There wasn't, cost of goods associated with those. So they had a big income at times. Well, that's a great time to, if you have a need to purchase an asset, whether it's a delivery vehicle or a pro rata max or redo your compounding, to buy those types of assets and accelerate that depreciation to reduce that particularly strong year. But there's other years where you're buying this asset, you think your income is going to be fairly consistent over the next several years. You can take a $40,000 a year deduction for the next 7 years. Maybe that's the better decision. And those are the types of we've got the tools available to us, which Jim is describing. It's just how to use them and when to use them. And when we talk about, what you mentioned, that 2018 tax rate, well, those rates are expiring in 2025, right? So they brought some of those rates down. So the 22 rate was 25%. The 12% rate was 15%, and so on. So those rates have come down and they're set to expire in 2025. So would I rather use a deduction today at 22 or at the lower rates, or would I rather have it when the rates are higher in the future? So those are just part of the timing questions. I mean, when you look at our economy as a whole, the federal government's having the same challenges that a lot of you as store owners are, and we as store owners. If you've got an SBA loan, it's probably variable and your rates have gone up, right? So you're paying more interest now than you were a year ago.
So is the government.
So is the government. And all that debt is being refinanced at higher rates. And so the question is, do we anticipate that rates are going to drop even further from where they are in the future, or are those rates going to go back up? And the odds that the tax rates in the future are lower than they are today is not good. You never know what's going to happen. But again, there's lots of reasons sometimes to just be patient and take deductions over time.
Yeah.
And you mentioned
they stay the same basically.
Yes. I mean, there's also, and I interrupted you, sorry, we're explaining bonus depreciation, and then there's also Section 179, right?
Right. Just to expand on what Owen said, hey, we take this depreciation this year because we want the whole deduction, and we want to do it this year because wait till next year it's going to be 80%. Well, the same thing happens next year. This bonus depreciation goes down to 60% next year, then 40% the next year, and then 20% before it completely dissipates, unless, of course, they legislate it back in. But right now, that's the current tax law. So, it's all depending on what's best for your circumstance. And that is the beauty of it. You have a lot of options to do. Rich was just mentioning Section 179 deductions. That's another convention you can use where it's very similar to the bonus depreciation, but it has a little more flexibility in some places, and then in other places it doesn't. Where it has flexibility is you can pick one asset in a category and say, I want to depreciate that using Section 179. You could also just take a portion of it as 179. So you've got a flexibility there. On the bonus depreciation, you have to depreciate it all. You can't, I said the default was bonus depreciation. You can make an election not to do that, and then you would fall into the regular makers, but you have to make that election. And bonus depreciation means if you have assets in a category, you have to depreciate all those assets the same way. If you take 179, that's one thing, but what's left would have to go under bonus depreciation for that whole life or that whole category. If you have a bunch of 7-year assets, every one of them that year has to be depreciated that way, unless you elect out of that. So that's one thing to keep in mind. The Section 179, a couple other things with that too. You can't use that to give yourself a loss. So if your pharmacy made $300,000 this year and you bought a $300,000 Parada, you could use that to wipe out all the income in that year. If your company only made $200,000, you couldn't take $300,000 of Section 179 deduction. You could only take $200,000, and then you'd have $100,000 carry forward of Section 179. If you use bonus depreciation or makers, that depreciation can take you into a loss situation. So if you had $200,000, but you had $300,000 of depreciation and get you $100,000 loss, if you had basis, which we'll talk about later, you have opportunity to take that, then you could actually utilize that loss on your personal taxes this year versus just have a break even and have to carry it forward. So that's just some of the juggling that all happens with the depreciation methods and what you want to do to try to take that.
Yeah. And again, we're not trying to fully educate you on all the ins and outs of depreciation as much as we are to make you aware that that's a tool, and how how your tax advisors and tax preparers should be utilizing that tool to help you strategically plan on how to use that in a way that best best accommodates your tax situation, right?
Today and tomorrow.
Today and tomorrow.
Yeah,
and,
right.
And we also see people, it's December, I'm going to buy this big piece of equipment, I'm going to spend all this money. And the first question is, do you need it? Right.
Yeah.
We often see people wanting to spend money on things that they don't really necessarily need at the moment. So
just to save some taxes.
Yeah. So you're saving taxes, but cash is going out the door, right? At
something
100%. So
right, like we bought a Parada because we had to, like we were forced to, because the software was going end of life. Like we didn't have a choice.
yeah.
And so it happened to work out that
Don't make bad business decisions
Right.
at the end of the year just to get a deduction and save some taxes when you're, again, when you buy a Parada or I'd say Parada, Script Pro piece of equipment, even a small piece of equipment, an Icon, buy it because you need it, not because you're trying to save a tax dollar, because, the dollar spent on the equipment is 100% out of your bank account, purchasing a piece of equipment to get a tax deduction. So
we ought to touch a little bit on how you're actually saving by, and what the ramifications of that is. Like, for instance, in some of those examples I gave, you're making 300,000 this year. Well, you choose to do bonus depreciation or 179 and write that all off in this year. So the tax rates that you're saving there is a blended rate between the 10% all the way up to 24 or 32%, and that's the benefit you're getting out of that. If you choose to extend your depreciation over several years, then you might pay taxes every year, but you're paying at the lower rate because each year you're taking $60,000 off of your income, and it's right at the top rate. So you're getting a bigger benefit out of that depreciation than if you took it all in one year. And it depends on your situation. You might be making $1 million and you want to take that 300,000 off because you're going to get that all at the 37% rate.
Right.
But if you're only making 300,000, it might make more sense to spread that out and get a bigger bang for your buck out of the depreciation. It's almost if you take the bonus or the Section 179, in some cases, you're wasting it because you're using that to decrease taxes at very low rates.
Or you might be totally low on cash and you're heading into 2024 and the DIR cliff, and you're going to need cash to cover that. And so we're going to eliminate as much and try to get a big refund and eliminate as much tax consequence so our cash can go towards making sure we get through the double up of the DIRs in March and April, right? So again, that's all part of the planning process. And depreciation is one of the biggest tools in the toolbox to do that, because we can push it out, we can accelerate it, we can kind of mix and match.
I think it's the perfect one to really talk about how you can manage, because you can really manage that. And that's where you really look at the timing of, lopping off some of the top where you can really have those really high tax rates.
And the requirement, again, is to have the equipment in place and in service by December 31st. So
in service is the key.
Yeah, you got to be using it. So you can't have it, sitting out in the hallway waiting to be installed.
Or pay for it on the 31st and get it delivered on January 20th.
Right. It's got to be in and up and running. Even if it's only up and running and you do one run on it on December 31st.
It's running.
Then it's valid. So
right. Which is why you want to plan. And we spent a lot of time on depreciation just simply because what they said was it's a big tool and it has a lot of different levers that you can move around. But we get a lot of calls about all kinds of other strategies, 401ks, inventory, all these other things. But, one that we don't get asked often about, and I don't think people quite understand, is self-employment deductions. I don't know if you want to take people through that a little bit.
Yeah, there's a few of those. We could touch on that pretty briefly, but, we want to make sure that your health insurance, especially some pharmacies don't offer health insurance to all their employees, but the owner gets it themselves, maybe on the marketplace. You want to make sure that the pharmacy's paying for that, because what happens is the pharmacy will take a deduction for it. It goes into your income, but then you get a deduction for it. So it nets out on your side, and then you can get a deduction through the pharmacy. If you don't do that, then you're really losing out on that deduction. There's things with retirement plans too. You want to make sure that you consider those. If you have a plan in place, to put the maximum number in or put whatever amount you want to defer. So because that's a straight, tax deferral, and it takes a long time. If you're younger and you're going to put that money away, you're not going to pay the tax on that for several years going out. So got a lot of things like that with the health insurance. and retirement plans. HSAs are the same way, it kind of work just like the health insurance does. Even if your pharmacy has its own medical, and or you put medical in and say, okay, the employees are going to pay 50% and the company's going to pay 50%. Well, in your case, really, you are the company, so you're going to pay the whole, or it's going to pay the whole 100% for you, and you'll get that deduction then. So it doesn't hurt you, but you charge your employees 50%. It's things like that you have to manage through, and you can take that deduction. And it does go onto your personal tax return as a self-employed healthcare deduction. So
employee bonuses would be another example at your end. If you've had a good year and you want to bonus your employees, if you're a cash basis taxpayer, you have to pay those employee bonuses before year end in order to deduct them this year.
Right.
If you feel like you're going to have a really good year next year, but you want to have a bonus this year, you could pay those cash bonuses in January for the previous year and take that deduction next year. So again, just those are some small ways to move some dollars around and to try to take advantage of timing and tax brackets.
And I mean, what I'm hearing here though is like, you've got these depreciation things. We have to put things in service at the end of the year. If you're on cash accounting, you need to make the bonuses before the end of the year. I think we just see a lot of people, they wait until December 20th or even February and they're like, okay, I gotta do my tax planning. And it's like, well, you're too late with
next year. Yeah.
You're too late with like 80% of it, depending, every situation's a little bit different, but if you're going to make money, well, really in any situation, you really should be thinking about this now, November. We're doing tax planning calls with the good majority of our clients this month so that they can have time to decide, should I buy this piece of equipment, and, should I do bonuses, or what else can I do between now and then to actually have this stuff ready and take advantage of some of this stuff.
Or even if I'm not going to do anything or anything like that, at least I know where I stand. Because part of the thing of tax planning is looking at where you are now and where you're going to be at the end of the year. So you're planning ahead, right? And looking at your cash needs, et cetera. I mean, that's some of the important facets of doing tax planning in the first place.
Yeah, you're right. Those are the calls that we're having now. And you're going to project out the remainder of your year. It is seasonal a bit. We're going to have, typically you have, because of flu shots and other things going on in the fall. So you usually have a stronger fourth quarter. We will have Caremark DIRs in November, December for the second trimester. But, calculating that, looking at what the book income looks like, converting it over to what's taxable, stuff like QBI, where you get a 20% deduction. So there's just a number of things to factor in and say, okay, here's what I think my taxable income. Have I put away enough? Have I, put enough, made enough in estimated payments throughout the year to cover my tax liability, and making sure that you're not trying to figure that out in March or April.
Yeah, that's a good point. I mean, that's not even a tax strategy. That's just being aware of your cash, which is, almost more important than anything that we've even talked about here.
Yeah. It's just king.
Yeah. I guess the other thing we hear, we rarely get asked about. So, we get asked about a whole lot, like Rich said, people call up and go, okay, how do I get rid of all my taxes? But, the thing that a lot of people don't understand that impacts a lot of your tax strategy is something called basis. I don't know if you want to go through and just explain what basis is, and then we can talk about, how does that factor into things?
Yeah, I agree. It's probably the most misunderstood or least understood aspect of your tax situation is your basis in your business, and
sometimes hard to explain too.
It is hard to explain, and we'll try not to get into too much detail, but it's really important that you or your accountant are tracking your basis and are aware of what your basis is for several reasons. And Jim will get into some more detail. I'll give you a little bit of a simple overview, which is
more complicated.
It's kind of but basis starts with, when you buy or start your business, you typically have to put money into your business, right? Well, that's basis. Cash in is equity in your business, and that's basis. it gets complicated out of the gate, because if you're an LLC and so you haven't made an S corp election, so you're a partnership or a sole proprietor LLC, you also get basis for the debt that you've signed up for, right? And personally guaranteed. So in that case, an example, if you're buying a business for $500,000 and you put $50,000 in, if you're an LLC and you've borrowed another 450, so you've got the 500, your basis in the business is $500,000. If you're an S corp, you lose the guaranteed, personally guaranteed debt portion of it. So in the case of an S corp, your basis is $50,000, and we'll talk about how you use basis and what basis is valuable for. But so that's a drastic difference between an LLC and an S corp, and most people are personally guaranteeing all the debt. There's usually significant debt out there, so having access to that debt as basis is really important. And then once your business begins, there's two things that take basis up. One is income. So if you make $100,000 in your business and you pay taxes on that $100,000, then you get to increase your basis by 100,000. Now your basis is 600 instead of 500. If you put more money in, it also increases the basis. So if you have more contributions to the business, it also increases that basis. Conversely, if you take distributions, which we all like to do, and we pull money out of the business, it will decrease. And we're in business to have the business make money and have us extract that money from the business, right? So distributions or dividends are a reduction in basis, and likewise losses are a reduction in the business. So if you lose $100,000 in your first year being open, if you're a startup, and that would be probably in your business plan, right? So instead of now having at the end of the year $500,000 of basis, you have $400 because I lost $100,000 in basis. So that basis is constantly adjusting based on kind of those four factors.
Right. Those are the big ones you really have to take into account.
And then the value is at the end of the road, if I sold my business for $1 million and I had $600,000 in basis, I'm really, it's your basis, like a basis in a stock you might have. Now I'm only paying, capital gains on 400,000 because I've got 600,000 basis. Although if I've distributed and I have zero basis and I sell my business, now I'm going to pay capital gains on $1 million. So that's where at the end of the road, that basis comes back into play.
Right. I mean, really, there's two big reasons to keep track of basis. And one is, like Rich was talking about, when you sell your business, you know what the basis of that is. So you can calculate your gain or loss based on what you're selling it for. The other really big reason is to be able to know how much loss you can recognize whenever your business has losses. So, you can't take a loss unless you have the basis to take that. So in Rich's example, where, you're an S corp and you had $50,000 and then you made 100 the next year, then your basis is 150. If you took 100 distributions, you'd be back down to 50. Now the next year, if you had $100,000 loss, well, your basis is only $50,000. So you can only take losses up to the amount of basis you have. So you can only take $50,000 of losses that year, even though the pharmacy lost 100. You can only report on your personal tax return that 50,000 loss, and the rest of the 50,000 gets carried forward to offset any future income you have. Then going forward the next year, if you made 50 and you had that 50 loss carry forward, that would net out. You would report both the 50 income and 50,000 loss carry forward against that, and then have to show no income for that year.
And an example of that would be too. So if you're in an S corp and you're employed in your store, you're probably pulling salary, right? So if you're pulling a good pharmacist salary, today's market, you might be making 150. And what Jim's talking about, if you're limiting your losses, right? So if we had $100,000 loss, but we were limited to only taking 50 because of our basis, now we can take, and we picked up 150,000 of W-2 wages, we can reduce that 150 down to 100.
Right.
And we get a refund for all those taxes we paid on the 50. if you could take the full $100,000 loss against personal income, you could reduce your income all the way down to $50,000, right? So that's typically how those losses, the business losses, come into play when you get to your personal return.
Right.
Because remember, as a business owner, you're probably pulling W-2 wages or draws, which is a little different. But if you're an S corp and you're pulling W-2 wages, you've got that income, and then you've got the business income on top, and the basis is going to affect the ability to use losses from the business against personal income.
Right. And that's why it's so important to really track that. We sometimes see clients that come in and they don't have good basis records, and we try to do the best we can. But the easiest way to keep track of basis is from the very beginning of your business, to track it from day one. And if you have a good accountant and tax accountant that's working for you, they should do that for you, because that's one thing that's so important, to keep track of that basis and have good records as you go forward, because it's going to in the end of your life cycle of the pharmacy, you're selling it, you wouldn't have good records, so you can document, I'm only going to recognize this much gain because I have, my basis is this high and I've already paid tax on this portion of it. I'm getting this much more, so I only have to pay tax on the rest of it.
And back to what we were talking about early on the timing. I mean, if you're limited in your ability to use a loss, so in our instance, if we could only use 50 of $100,000 loss against current year income, it's not like you're losing the other $50,000. It is a loss carry forward. So it's a tax asset. We would call it a tax asset because it's usable against future income.
Right.
And that may be just fine, right? Like we talked about, maybe next year, we can, but so it's not, again, once, the common theme here is that you're not losing anything. It's just a timing of when you're going to be able to recognize that loss and when, you're going to pay the tax or not pay the tax.
Right. It's all about the timing again, like we say. And, one thing too, is there's a lot of times it's talked about, distributions, really distributions aren't taxable. And what we're talking about there is, if you have basis to cover that, everything in your basis, you've paid tax on that already. So when you take that money out of there, it's like a checking account. You got the money in there, you paid the tax on it. Now I'm taking the money out and it's tax free. Where you get in the situation where it is taxable is if you don't have the money in there, or basically you don't have the basis. If you take that distribution out and it's in excess of your basis, then there's, there can be some things where we can put some things on the balance sheet and show that as a kind of an advance of against future earnings. The IRS doesn't necessarily like that, and could come in and say, well, yeah, you put it that way, but it's really dividend income this year, or you can pay dividend in earnings on it. So even in an S corp, you could end up with dividends. You have to pay taxable dividends and have to pay the dividend tax rate on that.
But the dividend tax rate is less than
it's 15%. So it's less than your most likely ordinary income rates, right?
And the same with, if you got to the end of the road and sold your store and you had utilized all your basis to eliminate income over the course of your ownership, and you were eliminating ordinary income tax rates at 20 whatever or 30 whatever, the capital gains rates at the end of the road are 15 or 20.
Right.
So would you rather pay a 20% tax at the end of the road on a zero basis and $1 million sale? So you're paying 20% on the whole thing, but over the course of the last, however you owned it, as opposed to having $600,000 that you were able to deduct over time against ordinary income. So all these are the kinds of scenarios that we're trying to take into consideration. And there's no perfect way to time all these things and to figure it out. But we do like to take these into consideration as we're looking at our store owners' personal tax situations.
Right. It's easy a lot of times to say, oh, I got a loss this year, so I can write that off of, as Rich was talking about in that example. I made my W-2s $150,000. My spouse works as well, and now we've got $250,000, so we got a $200,000 loss in the pharmacies. I can take that all off. Like, well, wait a second, we only have basis of $50,000, so we can only take a loss of $50,000. The rest of it will have to carry forward for future years. So it's something to really keep take into mind and try to understand. And like I say, it's easy to be confused about it. And a lot of times we talk about it, it's like, well, wait a second, but you got to take this into account. So, if you have a basic understanding of it and rely on your accountant to keep it straight for you, that's half the ballgame right there.
I mean, one other, this doesn't apply to a lot of stores, but something else that if you have multiple stores and they're held in different entities, we can find a way to shift around so that maybe you can take advantage of that loss.
Right.
So, management fees, other ways to move income between two different entities. One may be an LLC, has higher basis, one's an S Corp. Can we move income to the LLC or losses to the LLC where we can take advantage of those losses? So there's just a lot of different, I think that's just another example of.
Yeah. If you do have multiple entities, and then we're talking there where you've got two separate, federal IDs at two actual companies. A lot of times people own four different locations, but that's all under the same company. So you can't really do that because you got the one tax return. But if you have multiple returns, like Rich said, we can find a way to move equity into one or income into one or the other and take advantage of one that's got income, it has excess, and you move that over to the other one to take advantage of the loss that's generated there to make sure you can use the loss. If you have income, we're always trying to manage it and find ways to reduce that. If you have that loss there, you want to utilize
it. Question about inventory and how that plays into taxes. It can be a little bit complicated, so I'm hoping we can answer, but maybe you can just talk about inventory in general.
Well, inventory is an asset and it has to be on the books. We've got a lot of clients on cash basis, and that's really another thing when we talk about timing, where if you go to a cash basis, then you end up deferring the revenue and into the future. So you always kind of have that, I'd say, permanent deferral. I use that lightly, but eventually, you pay the piper because when you sell, then that revenue comes through and you've got no other expenses. But that's another timing thing. So even though we've got a lot of cash basis, you do have to have inventory in the books. And as it usually works, we have a balance at the beginning of the year, and if we don't adjust it till we get to year end, then if the balance goes up, then you've actually increased your income because your asset went up and then your cost went down, or it could happen vice versa, where your inventory goes down. That means your cost went up. So it does affect your income from that standpoint. And we always recommend that people try to keep, minimum inventory on the books even in stock as much as you can. Don't have a lot of, paid ahead for inventory that's sitting there for months and not getting any value out of it. So
even though you
added that,
just kind of reiterating, if you're on cash basis, that would typically say that you would not have inventory, but you are required to have inventory on the books. So, but if you've got inventory and you owe your wholesaler, so you can and haven't paid for that inventory, even though you are not accrual accounting and you're cash accounting, we would recommend that you go ahead and accrue the amount that you still owe on the inventory that sits in your book. So that will offset some of that.
Right.
And keep that in balance. But
and our whole reasoning for that is, if you have to put the asset on the books, but you haven't even paid for it yet, you shouldn't have to take that into income without taking the fact that you haven't paid for it yet. So you by putting the wholesaler payable on it reduces that basically wipes it out.
Yeah.
That's good. Any parting words here?
No other questions?
No, that was really it.
We confused the heck out of them. So anything else to ask. So.
If you do have questions, you can reach out to us and, or reach out to your accountant that you currently have. We do recommend, meet with your accountant earlier on because, if they don't meet with you around this time, they don't have enough time to provide you, strategies that you can take advantage of. So
right, you don't have enough time to act on that.
Right,
your end gets there pretty quick.
The whole goal of this wasn't necessarily to get you fully educated on any of the particular items, but to make you more aware of. I don't think that anybody on here is. Maybe some are actually preparing their own business taxes. Maybe they are. But in that case, you do need to be aware of all the details, but just make sure when you're talking to your providers that you're focused on, not just today, but the long term. Understand that most of the deductions and the tax strategies are around timing differences, not that there's some magical deduction out there that we can take that's just going to keep a limit and we're never going to have to pay taxes. But the time and the rates at which we pay taxes are really important. And that's the one thing that we have some control over. So that's what we're trying to really educate about. And there is a lot of confusion and misunderstanding about what basis is. I'm sure a lot of people are not tracking their basis correctly. We see it a lot even with accountants. And so it can cause you some problems down the road and definitely some challenges down the road. So we would encourage you to be aware of basis, talk to your accountant about basis, make sure they're tracking basis, and then work with them to say, to plan, long term and to not just look at today, but to look, a couple of years down the road, have an idea what you think your business is going to do. Today's world, it's kind of hard to tell. We're hoping that, next year, and we're seeing some signs that once we get through the DIR issues early on with your leftover Caremark DIRs from 2023, that even some of the reimbursements might turn a little bit. So that would be good. Hopefully we have some good positive income in the future, and we do some really good tax planning to minimize the tax consequence of it.
Yep. Well, thanks everyone. Again, we did record this, so if you want to rewatch it or forward it or miss some of it, it is recorded, and we'll be sending that out shortly. Thanks for the time.